Good morning, afternoon, and good evening to everyone who has joined us. We are delighted to have you join us for the launch of the 5th edition of the State of Blended Finance Annual Report. Before we begin, just a few housekeeping rules. I would like to let everybody know that this event is being recorded, and we will be sharing the recording with all the participants following the events. The recording will also be available on our website and on our YouTube channel. We ask that you please rename yourself to display your full name and the name of the organization that you represent. We ask that all participants turn their cameras off and mute themselves. And for the speakers, we will request you to unmute yourself and turn your camera on when we call upon you to speak. We ask that the audience use the chat function to direct all questions to the speakers. And we'd also like you to know that the State of Blended Finance report is now available for downloading on the Convergence website under our resources tab. So the website is convergence.finance and the report can be found under the resources tab. So on the agenda for today, we will begin with introductory remarks by Joan Larrea, who is the CEO of Convergence. We will then proceed to have a short presentation by the Convergence content team on the highlights of the report. Following the presentation from the content team, we will have a Q&A session with the audience. After that Q&A session, Joan will come back and speak to us about the key challenges in blended finance, and that will give segue to a panel discussion that will go on for about 40 minutes. And we will have a Q&A with the audience following the panel discussion, and Joan will close us out with some closing remarks. And so without further ado, I would like to invite Joan Larrea, who is the CEO of Convergence, to give us her welcome remarks. Joan, you have the floor.
Thank you, Olive. Welcome, everybody, whatever time of day it is for you. We are thrilled to be able to offer you once again a look at the state of blended finance as an industry. This is, as Olive just said, the 5th edition of our flagship report. And I am once again amazed at my team pulling it off so flawlessly in the continued remote circumstances that many of us find ourselves in. This is the most comprehensive report on blended finance that you can find in the market. And the methodology rests largely on our historical deals database, which is the largest repository of data on transactions that have used blended finance that anybody is aware of. Our historical deals database captures transactions that we have verified fit our definition of blended finance and that have at least achieved a first closing. And we will be presenting you some findings from the latest rendition of our database. We have some new features in this year's report. First of all, we're focusing on scale. You're going to hear it all throughout this presentation. We really want to focus on achieving scale through the use of blended finance. Secondly, we have become prescriptive in a sense. We have presented 4 key challenges that we're seeing that are ahead of us if we're going to really use blended finance to catalyze major private sector and base investment in the sustainable development goals in the developing economies of the world. And we are offering 6 recommendations for how to tackle those challenges. And finally, we have in this rendition of our report guest op-eds from a variety of folks who represent different parts of the blended finance ecosystem. So we will also hearing from some of those voices on the panel that Olive mentioned is going to be part of this presentation today. So I am going to pass on now to Aisha Berry, my colleague, who will kick off the findings from the report itself. Aisha, the floor is yours.
Great, thanks, Joan, and thank you everyone for joining today. So before we get into the findings from this year's report, it might be useful for the audience to have a better understanding of the data that we capture and what exactly we're tracking in this year's report. So as Joan mentioned, all data captured in Convergence's State of Blended Finance is based on our proprietary historical deals database. And as a result, all the data in our report follows our inclusion criteria, which we use for tracking transactions. So essentially, all the data in our report follows three main criteria. So firstly, the transaction attracts financial participation from at least one private investor. So this follows our mandate, which is really to increase levels of private investments in developing countries that are aligned with the SDGs using blended finance. So this differs a little bit from some other databases capturing blended finance transactions. So for example, the OECD also captures blended finance that is publicly blended. So for example, includes commercial capital coming from development banks, MDBs, and DFIs, where there might not be private sector participation, but there is commercial and concessional capital being blended. In addition, we also wouldn't capture a blended finance transaction that is only concessionally funded. So the private sector participation is key at the transaction level. So secondly, we're also tracking transactions that use concessional capital, and this can be used in one of four ways as our four archetypes lays out. So one is concessional capital can be used as concessional debt or equity in the capital stack. Second could be concessional capital structured as a guarantee or risk insurance. Third is grant capital that is used for early stage design or preparation funding. So for example, grant funding that's used to develop a proof of concept or conduct a feasibility study. So very early stage design activities. And lastly, grant capital being used as a sidecar technical assistance facility. So for example, grant capital being used for pre or post investment capacity building. And then lastly, the third main criteria is that the transaction is aiming to create development impact in the developing world. So firstly, all of the transactions in our database target developing countries. And secondly, they're all aligned with the SDGs. So the Convergence team tracks transactions based on their alignment with the SDGs and sub-goals. And then the last note I'll say is that the data for the most part that we track, so all of our historical deal data, it has reached at least one financial close. We do have some instances where we've also captured data on fundraising transactions, but we've explicitly stated in those circumstances, whereas the 680 deals that we're about to go into more depth on would have reached at least one financial close. And with that being said, we can make our way into some of the key findings from the report. So we move along to the next slide. So here we're looking at the market to date overall. So this year's report captures 680 blended finance transactions. This captures 5,300 financial investments dispersed by over 1,450 unique investors. So to date, aggregate financing in the blended finance market has totaled just over 160 billion, with annual flows averaging around 9 billion year on year since 2015. So the blended finance market has experienced a relatively steady deal count since 2015, averaging around 55 transactions per year. However, like the rest of the global financial market, the blended finance market was impacted by the effects of the COVID-19 pandemic. So specifically, when we look at 2020, we observe a notable decline in financing volumes. Blended finance flows declined by about 50% in 2020, averaging around 4.5 billion compared to 9 billion in previous years in 2019. So we do hypothesize in the report a few reasons for this decline. So one is the fact that donors and private investors provided pandemic relief and investments to existing portfolios and programs, which would divert resources away from new opportunities. So as an example of this, in terms of other research, the World Investment Report finds that greenfield projects declined by about 42% in developing countries in 2020. We also hypothesize that fund managers and deal sponsors may have postponed target fundraisers or decided to hold a smaller close. So this could explain why the transaction count was similar in 2020, but volumes were lower. And this is also reflected when we look at median deal size. So the median deal size for transactions in 2020 was around 30 million compared to 50 million in 2019. So if we move along to the next slide, we can look at the sources of this capital going into blended finance and the providers a little bit more in depth. So here we're looking at a few different sources of capital. We've divided concessional capital into official donor assistance provided by DAC members, so government aid, concessional capital coming from other sources such as philanthropic organizations as well as non-DAC members, and then commercial capital coming from the private sector, and then also development banks, so MDBs and DFIs priced commercially. So one trend that we observed is that although ODA levels increased to their highest level on record in 2020, most of this funding was in the form of traditional aid. So our data finds that ODA being provided towards blended finance transactions was 50% of volumes in 2019. And in general, our analysis finds that concessional capital really remains relatively unchanged in overall volumes year on year. So in the absence of ODA levels and concessional capital generally increasing significantly, we really advocate that concessional capital be used as efficiently and strategically as possible to tap into private capital. So then moving over to commercial capital, the largest proportion of commercial capital into blended finance transactions comes from public development banks, including MDBs and DFIs. As expected, private sector financing was lower in 2020 than in previous years, so around 1 billion in 2020 compared to over 2 in 2019. So really what this tells us overall when looking at the different sources of capital and the market trends more generally is really that blended finance flows at present are not on track to achieve this billions to trillions agenda. And this is really why our analysis this year focuses on scale. And as Joan said, we also put forth challenges and recommendations on how we see the market able to scale blended finance and private capital. So we'll go into that a little bit later in the presentation and during our panel discussion. So I'll hand it over to Nick next to take us through some of the data findings. Thanks.
Thank you, Aisha. So first we'll look at the financial vehicle structures used by blended transactions. So over the last 3 years, funds have been the most common blended transaction structure, accounting for about 35% in 2020. So they also mobilize more capital per transaction than any other vehicle type, with median fund size coming in median fund size since 2018 coming in around 94 million compared to the overall market median size of about 50 million. So private equity funds have gained particular momentum, accounting for almost half of all blended funds in 2020. And here at Convergence, we do anticipate funds to remain the dominant structure as they account for about 62% of fundraising transactions. We also note an increase in the frequency of corporates receiving blended capital, observing quite a sizable jump in 2020 to about 37% of all transactions. We also see a positive correlation between the rise in these company or corporate transactions and blended finance's growing role in the agriculture sector. So about 40% of blended companies last year were operating at some point on the agriculture value chain. So moving on to the regional targeting of blended transactions, following historic trends, we do see that Sub-Saharan Africa remains the primary destination for blended finance, with the region accounting for about 61% of 2020 deals. So this trend will likely persist, given that 44% of the fundraising deals that we've captured targeting the region. Conversely, however, deal sizes in Sub-Saharan Africa do continue to drop, which is a trend that we noted in last year's report as well. So from 2018 to 2020, the median deal size was 40 million, down from about 60 million registered between 2015 and 2017. Convergence also has observed an increased interest among blended finance practitioners for transactions in the Latin America and the Caribbean region. So nearly 50% of last year's fundraising transactions that targeted the LAC region reached a financial close in 2020, which is the highest rate of any region that we saw. So moving on to the sector targeting of blended transactions, we have seen a notable increase in the number of agriculture-focused transactions, which reached a high in 2020, comprising about 28% of deals. So the increasing pressure experienced across the agriculture value chain for things like better climate resiliency or reduced emissions is likely driving an increased demand for both concessional and commercial financing. And we're also seeing a transition underway in the energy sector. So Convergence notes a decline in aggregate financing for energy since 2018, where a median deal size has fallen to 63 million from about 110 million that we saw between 2015 to 2017. So we believe this could be reflective of a decrease in the frequency of utility scale energy projects, as well as the declining costs associated with renewable energy technologies, which in turn would reduce the cost of some of these energy projects. Here at Convergence, we also see that climate finance consistently makes up a large portion of the overall blended market. So about 50% of all transactions incorporate a climate change component, and this ranges across sectors, so from agriculture to energy and even into the housing market. These transactions have mobilized about $100 billion to date, and we do expect to see blended climate finance continue to account for a significant portion of the market, given that about half of the fundraising transactions that we are tracking having an integrated climate focus. So moving on to the four blending archetypes that Convergence tracks, we have seen a gradual decline in the use of guarantees and insurance products over recent years. So this is despite the fact that guarantees likely have the highest mobilization potential of all the blending approaches. So their more regular use likely remains hindered by a number of challenges, which includes that they are currently not ODA eligible and are perceived to increase transaction complexity because they introduce a third party into the transaction structure, as well as additional financial instruments. And moving on to information disclosure and transparency within blended finance and from blended finance structures, it is widely acknowledged that in the absence of sufficient accessible and comparable data from all stakeholders, efforts to scale blended finance will continue to be hindered or stunted. So our historical deal database underscores the magnitude of this information disclosure gap, which continues to persist in the blended finance space. So we were actually unable to identify an impact reporting methodology in nearly 70% of the transactions dated between 2018 to 2020. So while these transactions may actually release impact reports exclusively to the investors involved in the transaction, this figure still highlights the dearth of publicly accessible information on blended transactions. Where we were able to identify a reporting methodology, we do observe an increase in the use of end-line or final reports in the time period of between 2018 and 2020. So I will now pass it over to my colleague, Andrew, who will go over some of the investor-specific data and findings from the report.
Thank you very much, Nick. We can start by seeing that blended finance remains limited in its use by most investors, with most participating only on a one-off basis. In fact, 2/3 of the unique investors that we track within our database have made only a single commitment to a blended finance transaction, while 22% have made 3 or more and can be therefore classified as active investors, with only 5% having made over 10 commitments to blended transactions to date. We found that most of the multiple commitments to blended transactions come from the development community, in particular, MDBs and DFIs. And in fact, if we go to the next slide, we can see that MDBs and DFIs remain the most prominent investor group in blended finance. In fact, from 2018 to 2020, they accounted for 35% of the total commitments to the blended finance space. Interestingly, we can see that foundations and NGOs continue to represent the smallest proportion of total commitment to blended finance, accounting for around 10% of commitments in 2018 to 2020. However, they represent an outsized proportion of concessional commitments to blended finance, as we can see on the next slide, where from 2018 to 2020, they accounted for around 17% of concessional commitments to the blended finance space. There's a similar trend going on when we look at development agencies. So from 2018 to 2020, they accounted for around 12% of of total commitments to blended finance transactions, but around 37% of concessional commitments to the space, which comes only after MDBs and DFIs at 38% over the past 2 years. On the next slide, we go into a bit more detail in terms of looking at the activity of commercial investors in the blended finance space. What's immediately apparent is that financial institutions continue to dominate commercial investors' commitments to blended finance, accounting for around 40% of their commitments over the past 2 years. Earlier, we also noted the advance of blended private equity funds, and this is reflected on the investor side. So we can see that PE and VC funds from 2018 to 2020 accounted for around 16% of total commercial commitments to blended finance transactions, which comes after around 6% from 2015 to 2017, and around 5% from 2012 to 2014. We think that this is because blended finance is becoming increasingly incorporated into alternative investment portfolios. Finally, we can also see that there hasn't been a dramatic increase in terms of the proportion of commitments coming from institutional investors, which is obviously constituted by pension funds and insurance companies. Hopefully, however, we expect that we hope that this will change in the coming years with the launch of new groupings like the Net Zero Asset Alliance, which are increasingly focused on areas like climate change and wider sustainable development in developing economies. Finally, if we go to the next slide, we can see that on the slide, we can see that the league tables for the top investors in blended finance have remained pretty stable over the past few years. So MDBs and DFIs, for example, continue to dominate the space. We can see that organizations like IFC, FMO, and EIB continue to represent an outsized proportion in terms of total commitments to blended finance when compared to their counterparts across different organizational types. We can also see that commercial banks continue to dominate the league tables in terms of commercial investors, with organizations like Societe Generale and Mitsubishi UFJ Financial Group leading the way. We can also see that local investors or investors domiciled in emerging economies remain underrepresented in terms of the top investors that appear on our league tables. So this is a challenge that will be discussed by the panelists and which we explore within the report as well. But we can see from this table at least that organizations like Standard Chartered and obviously the AFDB do appear, but they are few and far between, and that the mobilization of local investors into blended finance transactions will be key to achieving scale within the market. Thank you everybody for listening. We're now going to go into the Q&A section of the event. So I'm going to hand back to my colleague, Olive.
Thank you, Andrew, and thank you to the entire content team. We will now take questions from the audience, and I'd just like to remind the audience, if you can please channel your questions through the chat function. And we do have our first question directed to Aisha. Do you predict that the decline in blended finance flows in 2020 will continue in the future, or is it just a blip caused by the pandemic?
Thanks, Olive. Sure, I can provide a little bit of insight into what we're thinking about trends going forward and what 2020 represents. So, I think it's, we obviously have to contextualize the 50% decline that we saw in 2020 compared to previous years as contextualized within the greater impact of private sector appetite and perceived risk in developing countries. So, we offer a lot of other investment statistics and FDI trends in the report to help situate some of the blended finance activity we observed in 2020. However, Convergence has been saying for the past few years that current flows of billions to trillions aren't at the levels needed to achieve scale, or the billions to trillions agenda, I should say. So I do think that the urgency for scale and the call for more blended finance flows is something that isn't unique to 2020, and the dip in 2020, I guess, only makes that more stark. We do offer a little bit of analysis as well in the report on some of the fundraising transactions. So we've captured about 70 deals that are currently fundraising as of now. And based on last year's trend, what proportion might close based on how many closed based on last year. And it still puts the number a little bit below that 55 average. So definitely the impact of the pandemic and private sector appetite will continue. It's not that we're sort of out of the woods in terms of some of the economic impact, but I think I'll leave it there and then encourage everyone to read that section in the report on how we predict fundraising flows will continue in the year ahead.
Thank you, Aisha. We do have another question for Nick. We see that companies have increased in proportion. How do their sizes compare to other deal types, and have they achieved scale?
Sure. Thank you all. That is a great question. We haven't seen, despite the frequency or the high frequency and growth for blended companies or blended corporates, we haven't seen a jump or a corresponding jump in the size of these company transactions. So they have been consistently sitting around $30 million of a median size, whereas in comparison to funds, as mentioned earlier, are sitting around 94 million. So there is quite a sizable gap. And I think this is due to a number of factors. I mean, one, given that there's just a demand for a smaller demand for capital. So these individual transactions aren't raising as much funding or aren't requiring as much funding as, say, a project, an infrastructure project or a fund transaction type. We also see a lot of innovative structures taking the form of company deals. So without a track record or proof of concept necessarily, these transactions aren't attracting as much funding and aren't necessarily looking to achieve scale in these transactions, but rather take a first step and be a first mover, which does require less capital. And I think finally, funds are playing a part in this. We do see, as mentioned by both myself and Andrew, that private equity funds and venture capital funds are making up a larger part of the market. So rather than blended finance being channeled or funneled into these one-off company deals, they are going through these financial intermediary structures, which then target a number of SMEs or small and growing businesses, both for diversification benefits for private investors, as well as to target a wider range of sectors. So I think I'll leave it there and I'll leave it open to more questions.
Thank you, Nick. We do have another question. Maybe Andrew can take this question. Are the top investor league tables by dollars invested mirror the number of commitments, or do they differ greatly?
Thank you very much. And that is a very good question. So what we can say, first of all, is that the figures in terms of dollars amount invested and the total commitment would mirror each other. So, for example, the statistics that we were citing earlier in the presentation about how MDBs and DFIs, obviously looking at the league tables, account for, in terms of the total number of commitments made to blended transactions, they're at a scale far broader than any of their counterparts across different organizational types. That's also reflected when we look at the value of the aggregate financing that's been provided to blended transactions. So I think over the past, from 2018 to 2020, MDBs and DFIs accounted for around 54% of the $20 billion of aggregate financing that was provided into blended transactions. So we do see a bit of a correlation between the commitments made in terms of the total number and the aggregate value of their financing provided. And just to clarify, that the figures on the league tables are in terms of the total number of commitments that have been made, rather than the dollar value.
Thank you, Andrew. And we do have time for one last question. And the question says, across the top investors, who are the top players you feel are getting it right? That is leading on best practices in blending finance, and why? And how might we highlight their best practices to help move others within this space?
I guess I can take that one and then obviously hand over to any of my colleagues to bolster that. Of course, lots of organizations are doing good work in terms of attempting to prepare themselves to scale the market and so on. One of the organizations that we do feel has done a great job in terms of making internal reforms is IFC, which has been doing a great job in terms of promoting transparency within their organization, particularly as it relates to the transparency of the transactions that they're involved in. But as I said, there's just one example of many organizations which are making those steps to reform internally to become more open and to better achieve scale within the market.
Thank you, Andrew, and a big thank you to the entire content team. I would now like to invite Joan back to speak to us about the challenges in blended finance. Joan, you have the floor.
Thank you very much. So as mentioned, we added to this report our observations about key challenges and also made some recommendations. We'll tackle the recommendations by way of having a panel discussion and hearing from other voices, but let me outline for you the challenges we are seeing, the four that rise to the top. First of all, we don't see among the donor institutions and development banks, particularly the donor institutions, a real private sector mobilization strategy and action plan. It is the secondary objective of development banks to mobilize capital after doing their own, moving their own capital, but it is only the tertiary objective of any particular donor. In fact, there are not many donors out there who consider pulling along the private sector, to be part of their core mission to achieve the development objectives that they have been mandated to achieve. So that's a problem, because again, as we've all been saying since 2015, there is simply not enough donor money out there to achieve the sustainable development goals. And if you don't drag along the private sector, we aren't going to get there. So there is not the kind of strategy we would think would need to exist in order to really move the needle. And donor capital is the chief constraint. If you look at all the data that my colleagues just presented, when donor money into blended finance drops, so does blended finance, and it is steady year on year generally. And where it doesn't go, you don't see blended finance. There was a question about why the Middle East doesn't see more blended finance. My guess is that there is neither donor appetite nor investor appetite for that region. So donor money is the chief constraint on the use of blended finance. And unless you have a strong imperative to pull along the private sector in your development activities, you're not going to see the leverage. The second thing we're seeing is insufficient participation or inclusion of developing country voices. So developing country governments are not really part of the conversation with blended finance yet. And there is a lot of domestic capital sitting on the sidelines. We're going to be talking about that too in the panel. That domestic capital happens to be in the right currencies and more familiar with the risks of its home territory. So if we can pull those actors along or give them space in the blended finance world, I think that would, or we think that would help a lot. The third thing is the lack of transparency on blended finance. You saw data from my colleague Nick showing that we from the outside can't see what impact requirements most blended finance transactions are calling for. We also don't know on the front end what that catalytic money required, on what terms it came into transactions, when it was concessional, in what sense was it concessional? Was it very patient? Was it declining upside? Was it shoring up downside beyond its own potential returns? In what way was a blended finance transaction put together? Without benchmarks, you have a circular problem where donors don't know what the impact of blended finance is and are less comfortable than they should be engaging in it. And therefore, they don't, and therefore so unless we start to put out information that allows everyone with that catalytic money to benchmark themselves, and everyone trying to draw that catalytic money to make a transaction that otherwise wouldn't quite work, unless we have that benchmarking information, we're going to be operating in the dark, and that is slowing down the advancement of blended finance. The fourth observation we would make is that the ecosystem is underdeveloped. Putting together a transaction takes time, effort, and money. And right now what we have is a wall of money. There's a lot of donor money. There's a lot of hard investment money that could be going into blended finance transactions. But the transactions that are out there there are not enough of them, and they're at too small a scale to absorb most of that money. So in the middle somewhere, you need to have more intermediaries who are familiar with and good at putting these transactions together, be they private equity funds or companies, or project financings. So you have to have more intermediaries who know how to put all of these unusual components together that make up a blended finance transaction. And there need to be more large transactions coming off the assembly line that are investable and familiar and vanilla. So the ecosystem is not there yet, and it needs help. So those are our four observations. I would like to invite our panel to join us now. And it's an amazing panel. By the way, all of you on the listening side, please do put your questions in the chat line. We will try to get to some of them, and hopefully that will engage everyone further. So we're going to spend about 40 minutes with our panel, and then have 10 minutes of Q&A from the audience after that. So let me introduce everybody in the order that they appear on the screen, and all of you should come on camera. So first of all, Cameron Khosrowshahi, who is with USAID, but is representing today Prosper Africa, which is a cross-US government engagement. We have also Chinua Azubike, who is the CEO of InfraCredit in Nigeria. Third, we have Cruzcaya Sierra Escalante, who is a senior manager for blended finance, the senior manager for blended finance at IFC. We also have Nancy Lee with the Center for Global Development, which is a longtime observer of the development space. And finally, Rael McNally, who is a senior portfolio manager in the global renewable power area for BlackRock. So welcome everybody. If you're not already in camera or on camera, please come on board now, and let's get started. I'm going to start, Chinua, with you, if I may. We spoke a minute ago about the insufficient voice that domestic institutions have right now in the blended finance world. And we don't see that blended finance has tapped yet into local institutional capital in a meaningful way. We know that local pension funds are a really large source of potential local currency investment capital, but domestic pension funds and their peers in many developing markets only allocate a very, very small amount of money to SDG, for example, infrastructure projects. So in your op-ed, which we've featured in our report, you look at what it means to build out a new ecosystem that would draw in local investors in blended finance. Can you talk to us a little bit about what that would look like? How can blended finance attract more local investors into sectors like infrastructure, where the local read on risk and the local currency is right there and available? So over to you, Chinua.
Thank you, John. So thanks a lot. InfraCredit is an example of a step that was taken 4 years ago, a collaboration between the Nigerian Sovereign Investment Authority with Pitch to establish a local currency guarantor that can mobilize long-term finance in local currency, essentially crowding local pension funds to invest in infrastructure in Nigeria, also enabling local debt capital markets to deepen its penetration. And since then, we've been able to help lengthen the yield curve for corporate debt because the local capital market has a very important role to play in helping sort of unlock long-term financing. And Nigeria does have a fairly developing debt capital market with pension funds sized currently around $30 billion Naira equivalent and growing at about over 15% per annum. Is literally doubled since inception of InfraCredit to date. And the opportunity we see is the fact that in markets where you do have pools of local savings, you've got local pension funds, local insurance companies, you've also have a local debt capital market that is also developing, and naturally an infrastructure deficit that, as it is in most markets, there is a room for intermediation in terms of helping to allocate capital to SDG related infrastructure projects, which by the case that traditionally we'd had to mitigate risk, so perception from an investor standpoint initially, because most of these type of projects sometimes do have track record constraints and performance data constraints. And so as a result, we don't see risk averse capital moving in that direction. And so there is a very unique role that we see that private intermediaries like ourselves and others can play in helping to, attract blending to unlock these projects to access institutional capital and ultimately address this perception of risk by actually being able to provide a demonstration effect. And this has happened in some form. We have benefited over time from some type of grants that help to do early stage project preparation or early stage technical assistance or cover some early transaction costs. But it's not significant enough to move the needle. The deficit in Nigeria is estimated, we require about $100 billion per annum over the next 30 years to bridge the deficit. And that's really just broad data available. But the reality is that if you look at a country like Nigeria, is got the highest energy deficit in the world of over 80 million people. And there's a lot of work and opportunity for blending to play a very critical role. Looking at the ability to walk through intermediaries that are built in a manner that can help first to address, again, hopefully the transparency challenge in terms of reporting, but also structuring and originating these projects. So what we see is appetite, but in terms of, we see capital. So local capital is available. Risk appetite is limited. Intermediation capacity does exist, at least to some extent, we see that. Now we want to see scaling. We would like to see more coordination. How do we get multi-donors to work together with the intermediaries to help scale up financing to this asset class? So we see an opportunity. I think we're really at that tipping point now. I mean, COVID is further constrained markets, but we do see a real opportunity to leverage the ability to mobilize capital. And we've done this, at least we've mobilized over $100 million in local currency across 5 infrastructure projects. We've lengthened the yield curve in terms of access to local currency debt to up to 20 years. So it's really a demonstration effect that can be really catalyzed further and help to sort of attract more of these impact projects to pension funds who are actually eager to invest, but really need a risk-sharing partner in terms of, who will take the first loss and who would help, in project structuring to make the projects more bankable.
Thanks, Chinua. When I listen to you and from what I know about InfraCredit, it's an example of an existing pathway for capital and for blending to achieve scale, yet the amount of money that you're being given to deliver on is wildly different from the demand that you're facing. So this would be an example of a way for donors and investors to use an existing pathway to really move the needle on the scale. And I'd love to ask you in a second, maybe we'll come back to it, why there is not an infra credit in many other places. But let's hold off on that for now. And let me move onward. I'm going to call on Rael McNally from BlackRock next, if I may. So BlackRock was involved in a really notable transaction, the climate finance partnership, excuse me, which is a really important example of how blended finance can crowd in significant capital from institutional investors. We're talking hundreds of millions of dollars in a single transaction. But there aren't a lot of examples of structures that have been able to operate on this scale, to achieve this scale of interest from private investors. So I would love to ask you, Rael, how do blended finance structures, how can we put more of these out there that appeal to asset managers like yourself who have fiduciary duties toward your investors? What sorts of things should be out there for you?
Sure. Thanks, Joan, and thanks everyone for having me here today. Obviously delighted to hear you describe the climate finance partnership in those terms. It's been a 3-year effort, door to door, from conception on stage at a conference in New York between Larry and Macron to finally execution. So delighted to be able to talk about what we've achieved in partnership with our DFI and foundation, kind of catalyzing dollars in this fund. So I also it looks like we've more than 20 investors across 10 countries. So there is interest and demand out there. So I think that's hopefully a positive takeaway for the audience. In terms of the ability to achieve this interest from private investors, I think for these strategies, a major issue is that you're asking institutional investors to go outside their comfort zone. And if you think about the role of an advisor, an investment advisor, or manager within those, they've got to go and advocate for something that, if it goes to plan, they won't get applauded for it. If it goes wrong, it's going to be squarely on their shoulders. And things like institutional inertia, self-preservation, self-interest are very real issues on all sides of this discussion. I think what helped us in this go around was our ability to show LPs what the strategy could do for their portfolios, how it differs or complements OECD infra allocations, how it retains lots of the key infrastructure characteristics that they like, and that we were able to talk them through the yield, total return, the recovery characteristics of the asset class, and show them that, in a transparent, eyes wide open dialogue, that we've considered the idiosyncratic risks and thought about downsides. That's really how we came at this strategy and how we came with the structuring we did between catalytic and institutional capital, was stressing for downside performance and capital recovery, and then modeling that out as best we could. But it really speaks to a need for broader education in this regard around emerging markets investment considerations. That really at this stage should be part of a lot of frontline academic research, should be a lot of taught in a lot of the financial programs where people are going to learn about economic theory and financial investment theory. But generally speaking, the level, frequency, the nature of the dialogue needs to increase across governments and institutional capital. What's the fundamental investment opportunity? What mitigants exist? How can people access them? And then maybe just in terms of how I think we got buy-in from the institutional side, I just speak to my personal experience with the Climate Finance Partnership and our risk-reward waterfall, where we essentially bifurcated the economic returns into 2 tranches: a higher risk return allocation, which was allocated to our mission-driven investors, and then an insulated tranche, which represents 80% of the capital we raised, which was primarily commercial investors. And really, with good portfolio construction, we believe that the insulated tranche can expect OECD-like risk return profiles, but the ability to access the fastest growing markets of the next 30 years, the fastest growing asset class, we believe, of the next 30 years. And at the end of the day, it's actually quite a simple structure. We spent a lot of time and iterated a lot on very complex and nuanced structures and variants, but that simplicity that we ended up with and something that gives holistic coverage to institutional investors, I think was really important, because trying to solve for the individual distinct risks is really not practical. Again, also having the DFI partners that we have here, AFD, Proparco, JBIC, and you know, we'll have another one joining in short order that we'll be able to announce soon, I hope. And having a seat for our institutional investors at what we've created, a climate impact committee, where we're going to focus on previewing deals, environmental and social considerations, compliance with IFC performance standards, and generally create a forum for knowledge sharing, perspective, learning, you know, the collective scars on our backs. I think that's going to be really helpful to give people that comfort and to give people access to feel that they're sitting at the decision-making table with people that have real experience, and they can ask the questions, and we can collectively make better decisions. You know, few people have more experience in these markets than the DFIs. So the idea that, you know, we're opposing each other or we're on different sides of this transaction, you know, doesn't really make sense. And this fund has thankfully been able to bring that all together.
Thanks, Rael. I think that offers a lot of useful lessons. First of all, the value, which is something we talk a lot about, the value of having something streamlined, familiar, as simple as possible, that people don't have to understand 52 different dials and knobs to understand the transaction. That's, I think, very powerful. I realize also that part of what you're saying is that blended finance requires people to understand each other's languages. And you're saying that there is not that much knowledge of emerging markets in your crowd, and there's not that but understanding of, you know, some of the things you'd need to understand to assess a transaction like this. You also, if you think about it, a transaction like this requires the catalytic money and the development bank money to understand what the needs are of the investors whom you represent. And that too is a translation or a cultural issue. So this is an example of a transaction that really needed people to operate outside their comfort zones in both directions. I also think it's an example of that ecosystem gap that I mentioned as one of the chief challenges. I actually happen to know, we know this transaction because we have a design funding program that provides grant funding for very early stage concepts. And we actually wrote a grant to a small team who worked on this transaction for quite a while before it became what it is today, which is BlackRock's baby. So it is an example of a transaction that probably would not have come to be without, as you're talking about, the Macron and Larry Fink meeting, but also an awful lot of behind the scenes work by a lot of you. So something like this at this scale needs a lot of time and effort. And as you say, if it falls by the wayside, there's downside to the people working on it. And if it works, not all that much in the way of kudos or whatever. So there's an issue there too. So the ecosystem issue, I think, presents itself in your transaction. Thanks very much, Rael. Again, moving on quickly to Cameron for Prosper Africa. Cameron, in your op-ed, you talk about since 2015, ODA has increased substantially to try to achieve the Sustainable Development Goals. And you talk about a need for an active, coordinated, concerted mobilization agenda. Tell me what the internal issues are in donor organizations that prevent something like that from coming to be. Why is there not, I don't know, the union of mobilization donor executives or whatever it is that you imagine? Why doesn't this happen?
Well, I'm a card-carrying union member, Joan, so I can speak about this. Thanks for having me, and thanks for this panel. So I think it's to put it bluntly, the disparity between actions and words, I would say. The mobilization agenda, as most people know, has been around since at least 2015 in public words. When we all got together at Addis and said that the private sector was critical to our goals. But what I'd call the mobilization mentality has still not permeated the vast array of foreign aid and development finance bureaucracies that was set up decades ago. And Rael talks about getting out of comfort zones from an investor's perspective. There's also a comfort zone when it comes to development agencies, DFIs, and MDBs. They are used to a world that no longer exists, where 90% of flows to developing countries were public. That has reversed now. So I think there still needs to be work done around a mobilization mentality, and a mentality that brings together these two worlds of foreign aid and development finance, and then commercial finance. Many practitioners see those two worlds as separate. And that's unfortunate, because there's a tremendous opportunity. BlackRock and others talk about the risks that investors face in developing markets. What we're seeing, and Convergence, Joan, has been at the forefront of this effort through the scale donor group that they run for us and other donors. What we're seeing is tremendous appetite from investors, tremendous appetite, and a greater and greater understanding of the risks of not investing in our markets, of staying too concentrated in mainstream markets. That is an opportunity to change the game that we're really not seizing. And I think we need to make a step change in mentality within our various institutions to seize that moment.
So the institutional barrier, in a sense, is mindset. May I paraphrase you in that sense?
I think the mindset is growing. I just don't think we're there yet, where the mindset has permeated all facets, and the incentive structure has permeated all facets of the system, to where it's mobilizing other people's capital rather than its own capital, first and foremost.
I have to agree with you. In our interactions with donor agencies, the people on the front lines are quite concerned that they may be doing something that would be looked at in hindsight as over subsidizing a private sector party, or veering away from development and operating, too much in the commercial realm. I think there is a cultural issue there, as well as the structural issues you're talking about, the incentive structure. It's a little bit like what Rail said, ironically enough, that there is not a lot of reason for your average human being inside this institution to step out of the norm. It really, I think, takes leadership from the top to say it is okay to go out and try to do something different. In fact, we have to. So perhaps that's what is missing. I want to ask you also, Cameron, did you want to mention a little bit about what Prosper Africa is doing on this front?
Well, part of Prosper Africa's brief, and thank you for mentioning that, is to modernize these tools for the 21st century, and to take a hard look at what tools across the US government we have available, and how they can be reimagined to pursue more of a private sector centered, private capital centered strategy. And so that is a mentality change, but it's even more than that, looking at what the market needs to take those risks. Chinua talks about credit enhancement and de-risking, very, very important. We've had tools, our guarantee, first and foremost, to try and shift that investor calculation. But I think they need to be upgraded, frankly, with new tools. And then the other mentality change that I would suggest is we need to start thinking about a portfolio approach rather than a transaction by transaction approach. We're too slow. We're too slow. And this is a risk strategy that the private sector has used since the dawn of man to diversify and reduce risk. We should be taking that strategy and applying it to our own tools, backing market actors that can actually, or quasi-market actors like InfraCredit, and unleashing them, frankly, rather than worrying about the risk of every single transaction and taking 2 years to do it.
Yeah, greater tolerance for failure is what I'm hearing there. And that is a key distinction, I think, of the private sector. The private sector fails and moves on because it has made multiple bets in multiple places, rather than banking all on one big program. Thank you very much. We'll come back. If time permits, I have so much more to ask you. But let me move on to Nancy of the Center for Global Development. Nancy, your contribution to the report, your op-ed focused on some aspects of the existing business model of the multilateral development banks and the DFIs that have led them to perhaps not mobilize as much as they may have the theoretical capacity to do, whether it is in the course of their regular business not using blended finance or in the tapping of blended finance. So if you look at their blended finance operations, what do you think should be the top recommendation on how to change the business model of a multilateral development to focus more on drawing in other private sector actors into investments?
Thanks, Joan. And I'm also delighted to be part of this conversation. Let me make three brief proposals in response to your question. And I think they very much pick up on the previous speakers, and particularly Cameron's point about mentality. So, and the 3 points are first, there is it goes really beyond mentality. There is, in the MDB world, a fundamental tension between the business model and mobilization. The second point I would make has to do with how to use blended finance more catalytically. And the third has to do with how blended finance providers should target returns. Just to step back on MDBs, when they were created in the middle of the last century, their principal purpose was really to expand public finance for development. It's a very efficient model, the MDB model. It uses capital very catalytically. It leverages the shareholder equity. It multiplies shareholders' equity many times over, and its profits can be used to add to equity over time. So it is an efficient banking model, but the world has changed, and it's changed both on the finance demand side and on the finance supply side. On the supply side, as others have mentioned, we know that simply adding to public development spending is not enough. We need huge private finance flows, both for the SDGs and for GPGs, global public goods, like fighting climate change and pandemics. And on the demand side, many emerging markets and some low-income countries have pretty robust capital market access, and their domestic capital markets have developed significantly, particularly their banking sectors. So what does that mean for MDBs? It means they have to adapt, and they have to now prioritize mobilization at least as much as the volume of their own transactions, which is the standard they are mostly judged by. And when I say that, I mean not only change institutional goals, but change the mix of their financial instruments. But we should not underestimate how difficult that is for the MDBs. They are banks. Banks generally don't design transactions to make space for others and to maximize returns for others. So it's no surprise really that they're reluctant to take very subordinated positions in capital stacks. And I would say on sovereign lending as well, there's room for MDBs to be more catalytic, especially for client countries that have capital market access. They could be deploying partial guarantees to raise sovereign bond ratings, in some cases to investment grade investments that are attractive to institutional investors. So my first point is that mobilization has to be a primary, not a secondary objective. But as MDBs often argue, it's hard to do well on mobilization in poorer countries, which brings me to the subject of blended finance. MDB data I'm aware of, which is regrettably scarce, as you point out in your report, suggests actually that transactions in poor countries yield financial returns that are not systematically lower than returns in higher income developing countries. So let's assume that the problem is not absolute returns, but rather risk uncertainty and scarcity of projects in poor countries. So what does that mean for the use of blended finance? Well, number one, it probably means that blended finance, at least the concessional part of blended finance, ought to be concentrated in the poorest countries, and we're not seeing that yet. Only 24% of DFI concessional finance was deployed in low-income countries in 2020, although that's changing and improving over time. But beyond the volumes of concessional finance, what are the implications for how it's used? And I would suggest that we need to specify and separate two objectives: risk reduction and risk transfer. The two are often conflated, but they're quite different. The former builds markets beyond individual transactions, and it gets at the central problem, which is that it's hard for lenders and investors to decide how much risk there is, and therefore what level of return is acceptable. So what actually reduces risks? Well, it often takes a constellation of financial products like grants, like first loss protection, like early stage equity, to solve a whole range of problems. Bad policies, weak regulatory institutions, scarcity of early stage development or project development costs, information gaps, first mover costs, and risks that are hard to assess up front. But the good news is that this kind of risk tolerant finance doesn't have to be large in relation to the size of the transaction. And the other good news is that MDBs have all the tools to reduce risk that I'm describing here. And in fact, as Puskaya, I'm sure, will describe, IFC 3.0 is moving toward this approach by taking on both upstream development, both on the policy side and on the project development side. And we have some early evidence that that's bearing fruit. And IFC's commitments in poor countries in 2020, even in the middle of a pandemic, were strongly countercyclical, in part because of support from the IDA private sector window, which is a source of blended finance that allows them to increase their work in these difficult environments. But there is a problem. Donor resources like the IDA private sector window are in short supply. The private sector window is only available to IFC. So how is all of this upstream development funding going to be paid for in a model which is heavily biased against rising transaction costs that eat into profits? So I would suggest what we need is as you have described in the report, we need concessional finance structures at scale with a broad range of financial instruments, grants, equity, and guarantees. And we need to offer access to these structures to multiple MDBs and DFIs rather than trying to build them in every single institution. And we at CGD have proposed a particular example of such a structure called the Stretch Fund, which you could find on our website. So this kind of pooled concessional finance would require MDBs to compete for access to subsidies and encourage a race to the top in terms of project quality and impact. So one last point. I think a few would dispute that blended finance should clearly be targeted for impact. DFI should be maximizing the value of development impact per subsidy dollar. And that should include emissions impact and health impact. But in practice, we can't compare ex-ante impact scores with subsidy levels, that is the gains versus the costs, because the impact scores are not published at the project level. And here, as an aside, I have to commend the IFC for at least publishing subsidies at the project level, the only DFI I'm aware of that does that. So what happens is that instead of publishing impact-adjusted returns, DFIs generally take a portfolio approach and do some projects for impact and some projects for financial returns, which makes it hard to judge how much impact weighs in their investment decisions. So I would suggest instead that they should calculate impact-adjusted financial returns at the project level, both ex ante and ex post. Ideally, with a common methodology across institutions, they could set hurdle rates, excluding projects with impact-adjusted returns below some thresholds, and the hurdle rates could be higher for blended finance transactions that involve scarce concessional funding. And I would say actually anyone that self-identifies as an impact investor should be doing this, including private investors. So 3 points to summarize: mobilization has to be moved front and center. Blending canon should be deployed in ways that boost both mobilization and impact. And 3, calculating impact-adjusted returns would help us judge whether blending is being used both efficiently and effectively.
Thank you, Nancy. Very concrete and very interesting proposals. I think our audience will have an interesting time digesting a lot of that, but I appreciate the directness of your comments. I'm going to turn, last but not least, to my good friend Kruskaya. Kruskaya, one observation is that when we talk about blended finance and mobilization, we may be conflating something. So let me unpack something before I ask you a question. So development banks and development agencies should be focusing on mobilizing the kind of capital that rail manages. That doesn't always need blended finance. There's an awful lot of work that a development bank does where they put out a transaction that has co-investment from an institutional investor or a B loan syndicate or whatever. And there's only a subset of those sorts of activities that might need blending because the place in which the transaction is happening or the sector or the business model presents such outsized risk that you need to blend in order to attract the outside money. But historically, at least my experience in IFC, you either are talking about mobilization and your best assets and putting them out to the private sector, or you're talking about blending for the most troubling or difficult assets that you want to put out. And there's not a lot of questioning internally about how do I blend for mobilization? So we've been talking about being in mobilization. I want to actually get to that exact intersection. What do you think that you and your peers can be doing to use blended finance, not just to de-risk your own entry into high-risk areas, but to induce others to go with you? That is blending formalization. Maybe you could comment on that. And also, if you have any comments on the transparency side, I'd love to hear those as well. Thank you.
John, thank you very much. And, just to thank you, Convergence, again, congratulations on the report. We need a lot more information, with IFC and the other DFIs, we have been trying to do that on the concessional finance aspects of it, but we need more. So, my congratulations on keeping at it. I think as you have indicated, there are two different things. One is the commercial mobilization. We want to do more of it. And, at IFC, every transaction, and, people mention here that not always, it is so clear that, in every transaction, there is, an aspect of mobilization. But, in every transaction, we are trying to bring, some of that. Some of it will be what we call, the private sector mobilization, that is basically other commercial money coming in. In some of the hardest cases, is only going to be the DFI at commercial rates mobilization. But then you get to the other aspect, which is okay, where you're going to use subsidies. So how do you do that in a way that is not only making IFC do the deal, but bringing out others? And I'll go back to the basic principles. And I think for those of you that are not so familiar with it, every transaction that IFC does with blended finance has to follow a set of principles that was agreed in 2017 with the other DFIs. And one of the core principles is minimum concessionality, but minimum concessionality has the rest of it, which is crowding in. So you look at the smallest amount of concessionality you are going to provide, but it's not only to support IFC in the most efficient way. That also, but it's also to ensure that you are not crowding out commercial money, and that instead you are trying to crowd in others. So I think as we, a couple of things that we have seen is, first of all, the domestic what we are doing with some of our domestic financial institutions is very important. Helping to de-risk them is quite important. Sometimes we don't think about that as the mobilization, but bringing institutional capital to go to some of the most difficult markets, unless it's in infrastructure, may not be so simple. On the other hand, working with domestic financial institutions, even in SMEs related to gender and agri, it is possible. And then you add, the benefits that Chinua was saying of the local currency. So working with, structures, risk-sharing facilities to work with them, and we have done some of that, the small loan guarantee program with the IDA private sector window, we find that important. And then you are making a little bit of bringing their capital, because we are only de-risking them partially, bringing their capital, bringing IFC's capital, and then using the blended finance to bring, all of that. The other thing that, as you noted and the report notes well, is the utilization of funds. I think, when you look at the early days of blended finance, most of it was senior loans with a discounting interest rate. Then we tapped into subordinated loans a little bit, but we have seen a huge increase into, in funds. And a lot of that is going to be more substantially sized funds. And I think us thinking about, bringing amounts of blended finance that is helping, one, de-risk the senior investors, and two, also, if there are incentives that we can provide to the fund manager to do what Nancy was suggesting, which is increase the impact that we are going to achieve. So, put them certain targets and tell them, okay, if you achieve this, you get to keep a little bit more in your, in your fees. So these are some of what we are trying to bring down now. And it's a pity to see that, at least the overall market level, we are seeing less guarantees and less of these de-risking instruments, because they are essential. I mean, fortunately, in IFC, and this has been partially because of the availability of the IDA private sector window, we have moved quite significantly into these de-risking instruments from 2017, and that includes not only investing in funds, but also through early stage equity investments in some cases. Very challenging to even assess the level of concessionality, Nancy. And again, it is work in progress. And I think that is something that we have requested many others, why we don't, come together into this. I mean, it's not going to be perfect. We can argue that there might be perfect measurements of the level of concessionality, but if we start at least in one place, then I think there was a question that I saw in the chat, then you can start putting together benchmarks. And IFC, since, a couple of years ago, at least we are calculating the level of subsidy and indicating the averages of across our transactions. So you at least get a sense, if you're using senior loans, what's the average? If you're using guarantees, what is the average? It may not be a complete database, but it is taken, as there. I think, the other thing that I think it's quite important to highlight again is in terms of this mobilization, aspect, John, is the important to think about it of, where you can mobilize this. It's not going to happen again, in some of the more challenging sectors and in the smaller transactions. Then you need to be thinking about aggregation models. And this is not going to be for institutional investors. On the other hand, when it comes to some of the larger projects, in particular in infrastructure, it probably makes sense. And that's where we should be thinking about, can we, use the blended finance, just to risk adjust, the perception of, of the challenge. Finally, I probably will also just like to add, what Nancy was highlighting, that, although blended finance is a fantastic tool, and at IFC we have been able to align it very much with our strategic priorities so that we can, push investment in the lowest income, either in climate, in gender, in food security, in SME finance, and, more recently also on some of the refugee finance, issues. It is not a silver bullet, and you need to have the technical assistance. And, John, or some of the project prep that you are doing, some of the analysis of structures that you are doing are essential. And then, as Nancy mentioned, this upstream work. How do you think about, the regulatory environment, the ecosystem, so that, it's not only supporting one project, which again, it's great, and we should do more of the demonstration.
I think we might have just lost Kruskaya for a moment.
More of the projects, you may be out of it. Do you hear me back?
Yeah, we lost you for a moment. You're back.
Okay, great. Sorry about this. So I think that's what I was, saying, that upstream work is, I think, and another key aspect of it. Again, a powerful tool. I think, as John says, we should continue to utilize, blended finance to try to make sure that we are, creating a lot more impact, that we are mobilizing a lot more, private sector into the most challenging, and difficult places. And, for climate, I mean, we are seeing huge needs in the context of climate, and we hope that, basically we can continue to partner with, the development partners, the governments, as well as foundations. You have seen that, we have done that as well in the recent past to try to keep moving, this ecosystem.
Thank you, Kruskaya. There's a lot going on at IFC, obviously, in a lot of dimensions. Let me ask a question all the way around the room. We reported in the report that blended finance right now, when you break apart, if you aggregate all the transactions and you break apart the components, the leverage ratio, that is the amount of concessional capital it takes to get a commercial dollar into a transaction, is something around 1 to 4. But of those commercial dollars, most of it are coming from places like IFC, and it's actually $1 of catalytic money to about $1.10 worth of seriously private money, like the kind that BlackRock manages. How do you all feel about that? Because there's one thing about growing the pie by growing the amount of concessional capital interested in mobilization, but there's also an efficiency question. How do you all feel? Do you feel like that's the right number, way off, in any order? Maybe I'll just ask Chinua, what do you want to go first? And then I will ask, and maybe in the order we spoke. So Cameron, Nancy, and Kruskaya. Good number, bad number, and why in quick sequence, if you could.
I think context matters in terms of the market, the perceived risk in the market, and also the time, because we look at this over time. It's in the sense that when we support a first transaction, there's an expectation that over time it catalyzes more investment and requires less concessional support. So by building that into the whole, model from day one actually gives you a broader sense of what the expected impact over time could be. So on day one, it may be 50-50. We've seen that just because of risk perception. But over time, we see, even we've had a situation where a borrower who benefited from our guarantee went back to the pension fund and didn't need a guarantee the next time. So we see this happening as as example.
Great. So the graduation effect is important, and obviously leverage is not everything. I just wanted to see how you're all feeling about it. Okay. I think next was Rail.
Yeah, happy to jump in there. So I would completely agree with that. Like, that's our objective with the Climate Finance Partnership. Is version 2, version 3 doesn't require the concessional capital. The concept is proven, and we've built capacity and understanding and knowledge, and capital is naturally flowing to these opportunities. It may be required in different ways, but hopefully not at our fund level. We were able to achieve that 4-to-1 ratio you referenced of true institutional capital to DFI capital or concessionary capital in this fund, which is great. And I think we see the same stats that you saw in terms of the reality being more one-to-one when you start stripping out how other DFIs and multilaterals are playing in these funds. But I think we should all take heart from what we were able to achieve with CFP, and there's no reason we should be the only people that are able to achieve it. I think it speaks to some of the earlier points around just changing the narrative, increased education. Like there's a lot of competition in the OECD. It's been a perpetually low yield environment. We are talking about inflation, but those two factors are potential tailwinds for institutional money to consider emerging markets infrastructure as a lower way to play in the emerging market space.
That's a good moment.
So hopefully there's something there.
Again, very quickly, Cameron, Nancy, and Krutskaya.
Yeah, Joan, fully agree with Rail and Chinua. I think we can do better over time. I'm shocked we haven't done better. If you look at the underlying data, let's just look at what Moody's has released both in 2014 and 2020 in asset classes like infrastructure. The default rates are comparable. What is the issue with the system here? If the default rates are comparable, and in fact, in some cases, Africa is lower than North America, we've got a problem with the underlying system. And we'll be coming out with a full-fledged report on the credit rating system in the coming weeks, but I think we need to address this and a number of factors. One of the things the MDB and DFI community could do right now is release more data, as Nancy alluded to. There's no reason for it. Investors need to price risk. Let them price risk with data instead of assumptions. So let's face down the lawyers. There's 1,000 data companies out there that get around these issues of confidentiality every day. So it's doable. Let's release the data and let the investors accurately price the risk, so we don't have a 4-to-1 leverage, we have a higher leverage.
Thank you. Nancy?
So I agree with what Cameron just said. Basically, I think leverage mobilization ratios could be much higher. 3 reasons. Number one, it depends critically on where you are in the capital stack. If you're in the subordinated position, you're just going to mobilize more. As Chinua said, it also depends on the stage of maturity of the firm. And DFIs ought to be in a position of handing off pipeline to commercial and, let's say, less risk tolerant investors. Number 2, if you're simultaneously working on the investment environment, as IFC is doing in its upstream development, you're going to be increasing mobilization because you're going to have positive spillover effects in broader markets. And number 3, as I suggested, if you can start using a methodology for adjusting your returns by impact and having that methodology spread to a wide range of impact investors, you're going to start capturing these investors that at least say that they want a much greater share of their portfolio in sustainable and ESG investment, and you will give them a way to measure that they're doing that and demonstrate to their fund sources that they are in fact doing that.
Krutskaya, maybe you reflect on this, or just give us a sense of what you thought everybody else's comments to date, because I think IFP is a place where a lot of blending happens. So maybe you can give us some perspective from that.
The perspective is, again, it has to be contextual, John, because it cannot be the same for, blending in the middle income countries in, closer to commercial technologies in infrastructure to what we are doing in the IDA PSW. We are so proud to say that up to this point, together, IFC and MIGA, for the IDA resources that we have received on the PSW, we are doing 1 to 5. Not all of it is private capital, but the 5 is commercial. So I think, again, at the beginning, it's going to be, the sponsor money, the DFI money, and, the concessional money. As we continue to move and graduate, we need to increase those numbers. However, in some other areas, we should be looking at much higher numbers. So I fully agree with Chinua that it's contextual and we need to keep pushing for it.
Thank you. There is one other question in the chat line, I think is kind of an interesting one, which is one of our observations is that host country governments, as well as the host country capital markets, are not sufficiently making use of blended finance. And maybe, I don't know, Chinua, if you might be best positioned to answer this question, but is there a possibility that governments don't invite private sector investment in things like infrastructure because they actually prefer to manage the sector themselves, that they don't necessarily want to involve private sector parties? Is that at all a factor in blended finance in general?
So I wouldn't say it's intentional. It's just that maybe the government in some countries, they struggle, the risk perception or the risk perception and from a private sector perspective and the capacity is perceived to be weaker. And so some type of, some critical projects that are large, government tends to take it on their balance sheet because it appears much easier for them to do that. But over time, clearly we're seeing the constraints. Even in Nigeria, the medium-term expenditure framework sees the capital markets and the private sector potentially playing a very critical role in mobilizing funding. It's the how, and that how, obviously, it's sort of the how involves quite a number of actors coordinating across the life cycle for unlocking this or getting these projects to the ground and to financing. So there is, and where we have a capital market, there is really an opportunity to scale. But then it's really how we allocate blended finance to play its role in actually enabling projects and addressing risk and also blending cost, because high inflation rates also are things we struggle with, and that affects interest rates on projects as well.
Thank you. I am afraid that we are out of time for more questions, and we could probably go all day. I do want to thank each of our panelists deeply for your help and your camaraderie and your fellowship in thinking through some of these really difficult issues. I have a sense that if I left you all in a room, you would come out with $1 trillion blended finance transaction that actually makes sense and achieves lots of objectives. So I encourage more of this sort of cross conversation across the types of capital and across the mandates that we had today. That's what makes blended finance possible. It also makes it more difficult to pull off. But thank you all very much. Again, you can access our report at www.convergence.finance/resource. You can reach us if you'd like to at the email on this page. And I would like to take the moment to thank my colleagues for your usual amazing work. And we will close out. Thank you everybody for participating, and hope this has been a valuable experience.